If I had started my entire trading career from scratch, I wouldn't begin with trying to find the perfect strategy. I wouldn't spend hours hunting for the next big coin or obsessing over indicators, and I definitely wouldn't repeat the same mistakes that cost me years of wasted time and money. Because here's the truth, most new traders are focusing on all the wrong things. They don't fail because they're lazy or because they don't want it badly enough. They fail because they get stuck in a loop of hype, confusion, and inconsistency, and they never learn how to break out of it. In this video, I'm going to show you exactly what I would do over a 30-day period if I had to start over again. I'll walk you through the most important things to focus on and what to ignore, even if you're starting with zero experience. Hi, my name is Janet and this is 𝗟𝗶𝗹𝗃. If you're new here, welcome. If you're returning, welcome back. Be sure to hit that like button for the YouTube algorithm and hit subscribe if you're not already subscribed so that you can be notified every time I upload a new video. Let's get into it. In order to know what we should be focusing on, we need to know what not to focus on and what mistakes to avoid that can lead you into the sort of abyss, not making progress, being stuck at the same point and spending years of time losing money, being confused, and ultimately quitting. This is a mistake that I see almost every single person making and that I personally made in the beginning of my trading career. So don't think you're alone. We all go through this process and I am by no means exempt from this trader's journey. If you fall into this trap, this will completely halt any progress that you are making and keep you stuck where you are. This is probably the biggest foundation that you need to know as a trader. If this sounds like you, stick with me so I can help you navigate out of this frustrating phase. When you first start trading, you end up finding a new strategy, pattern, or idea and immediately put some money into an exchange and start trying to execute on it. So oftentimes what will happen during this process is because you're unaware of the risk implications, you're actually able to be braver than most traders, to the point where you open a trade and risk 50% on it because you don't know any better, and you'll probably start to make some money off trading and think, I've cracked it, this is amazing, I should keep doing the same process but with larger and larger amounts of money. Let me just go sell the house. And this is the psychological phenomenon of beginner's luck, where newbies experience the euphoria of success. And this happens because you're not overthinking about all of these things. Risk management, win rate, leverage, stop losses. You're actually able to see more success than people with more experience, which is simply the premise around beginner's luck. Phase 2 of this mistake is you'll continue this process and eventually you'll run into a position where you start to take a massive loss and say, I'm down so much money, I can't sell because I don't want to lose this amount of money. The trade may start to reverse to the point where it comes back to your break even, where you decide to close in a slight profit for a small win. Saved by the bell. And you'll reinforce this ideology where you think, if I just hold through losing trade, I'll eventually be able to make money off it. I don't have to realize the loss, and if I just hold through this, I'll just end up making money anyway. And this is what's happening during this phase of the trader's journey. The third phase of this mistake is you follow that exact same ideology where you try to hold through the loss, but instead of turning around, the trade continues to move aggressively against you, and eventually the loss gets so bad that you're forced to close the trade or get liquidated, losing a lot more than you had originally intended, which leads you into the fourth phase where you think you now need to find a new magic indicator, a strategy to prevent yourself from ever losing again. And in this phase here is where 90% of traders stay, never progress out of, or give up altogether because there's a fundamental flaw in logic. I call this the rabbit hole of learning and improvement. This is the part you really need to learn to understand where you need to rewire the way you think as a trader. The normal human instincts that make you successful do not apply in trading and will have an adverse effect. In everyday life, whether it's work or anything else, if something goes wrong, your instinct is to fix it. But in trading, that instinct can actually work against you. You don't need to win every trade to be profitable. You could lose 7 out of 10 trades and still come out ahead if your risk and reward are managed properly. And I know that sounds really simple, but this is where mindset and psychology start to play a huge role, because because when you lose 5 trades in a row, win 2, then lose another couple before hitting a winner, it really messes with your head. It's like to the ego. It makes you feel like something's broken and you need to go and fix it. But in trading, that's just part of the game. It's not about fixing every loss. It's about trusting the process, sticking to your edge, and letting the math work over time. This is going to make more sense as we make it through this video, but just understand that you're going to need to rewire the way you think and the way 99% of people think in order to be successful at trading. Now, I want to let you in on a little secret that is taught in detail within the TBD course, and this is the market maker's objectives. The market maker has 3 objectives. 1, induce retail to take a position. They induce you to do that by driving price out of the range. When you see price consolidating or going sideways, this is the market maker building their own positions whilst getting ready to drive price out of the range, as this will induce retail to take a position. Once that happens, all we have to do is wait for them to drive price out of the range, as this will signal the beginning of their move. There are ways to get in on this move before it happens, however, this is taught in detail within the course. Number 2 is to create panic and fear to make you think irrationally. If you've ever traded before, ask yourself, have you ever waited for a particular level to break, but price just kept going sideways in consolidation for days, sometimes weeks, #borings, and you're left waiting? Then all of a sudden, bang, big red candle comes out of nowhere, and now you're thinking, damn it, I've missed it. The same goes with retail patterns. If you've ever found yourself waiting for a breakout of a symmetrical triangle, but the breakout comes unexpectedly, it makes you think irrationally because you've waited so long for it that now you don't want to miss the trade. So you start to think or not think and make irrational decisions. For example, marketing in on a giant red candle or placing your stop loss in the middle of the move so it doesn't screw your risk to reward because you don't want to miss it and you convince yourself that this is the one. This is done by design. A large green candle breaking to the upside or a large red candle breaking out to the downside is all part of the market maker's objective to create panic and fear. And number 3 is to hit stop losses to pocket your money. To beat the market maker, you have to know what they're capable of doing. You might be thinking, well, why am I even telling you this? And the truth is, if you have found yourself stuck in phase 4 of the trader's journey and you feel you've tried everything but haven't yet learned the TBD system, then knowing these 3 objectives alone may give you that spark or hope for you to continue your trading journey. And if you're still in phase 1 to 3 of this trader's journey, then knowing the market maker's objectives will put you ahead of the game so you can hopefully avoid getting stuck on the path to profitable trading. Regardless of what trading strategy you use, these are 2 data points I want you to focus on and wish I had started with instead of chasing hype or big gains. And this is your winning percentage and your risk percentage. Your winning percentage. So what percentage of the time are you right versus wrong? And when you are right versus wrong, how much money are you making when you are right versus how much money are you losing when you are wrong? So to make this super easy to understand, I'm going to walk you through it step by step. First, I'll break it down on a calculator so you can see exactly how the numbers work. Then I'll show you a real trade example so you can see how it plays out in real life. And finally, we'll jump onto the chart and look at a cleaner, more digestible example so it'll really click. For simple math, let's say you start with a $10,000 account balance and we calculate this over a number of 50 trades. Say we're risking 1% of our account with a 3-to-1 minimum risk to reward, meaning if we lose a trade, we lose the 1% we have risked. However, if we win, we make 3 times the amount we risk, which would be 3%. And let's say we're right 40% of the time. Let's calculate that. So we can see starting out with a $10,000 account balance over the course of 50 trades, risking 1% and being wrong 60% of the time, our ending balance ended up being $13,360. The average gain per trade was 0.60%, with 20 of the trades being profitable and 30 of them being losing trades. This proves that trading has nothing to do with being right or wrong on any given individual trade. It has to do with your winning percentage and your risk percentage. And finding combinations on the charts is going to allow you to exploit this formula. So first, we want to work out our risk. So if we have a $10,000 trading account and we want to find find out what 1% of that is, that's going to be $100. So if I was to take this as a W trade, which is part of the model we trade in TTC, and I wanted to risk 1% on this trade with the target being this unrecovered vector candle, that means if we can expect for this level to be reached before this level, that's going to give us a 3-to-1 risk to reward ratio. This area is going to be the area we leave for a contained loss, in this case $100. With this area, regardless of the dollar amount, it is going to be 1 unit of risk. For example, if you were willing to risk a fixed dollar amount, say $20, this means from your entry to your stop loss, the most you are going to lose is $20. If you were risking 10% of a $1,000 account, which is $100, the most you are going to lose from entry to stop loss is, you guessed it, $100. Regardless, this is counted as 1 unit of risk when we're talking about risk to reward. And this is super important to understand, because in normal everyday life and just in general, when you're wrong or lose money, these are behaviors that typically need to be fixed, modified, or changed in order to prevent yourself from being wrong. But when it comes to trading, this mindset can have an adverse effect. If we come back to the trade return curve graph, there are going to be times where you win a trade, lose a trade, and sometimes take 1, 2, 3, 4, 5, 6, 7 or 8 losses in a row. So a lot of people come into trading and think, okay, well, if I can take 3-to-1 trades and win 2 of these per day, then this will be, in this case, $600. However, the problem is if you set these daily goals when you're starting out, then there's going to be times where you have 3, sometimes 7 consecutive losing trades, and over the course of 3 days, you're just taking loss after loss after loss. And normally what people do if they have these daily profit goals is they'll increase their risk, try to force trades or take more trades than they usually would to try and catch back up to that daily goal. Our main goal is to find setups in the market by using market structure, indicators, and reading candles to anticipate the direction the market may be heading next. If we can anticipate the market direction, then we can set up our trade and hopefully make more money than we are risking. If you are actively trading, make sure to do it smart. We've partnered with LBank exchange to offer you guys a 20% trading fee rebate for life. There's no catch. All you have to do is sign up using the link in the description of this video. So let me break this down so I can show you these 2 data points that we've just learned. So I'm going to be charting this as if I was trading the TBD model, which is the model we trade in TTC. So over the weekend, I can see we had a typical weekend trap. So what I am waiting for now is to see what happens when the market opens around Sunday 5 p.m. New York, which is where the shaded background changes color here. So I can already see we've had one little spike out of the weekend trap, and we have another one here which has formed in Asia. So I'm looking for an early change in market structure. In this case, I'm looking for a W formation. I'm going to mark out this blue vector candle here as my area of interest, because if price is to come back into this area of interest, I want it to give me that higher low here, not to drop any lower and release any of these traders who opened short during the down move out of the weekend trap. And I ideally want that to happen in another session or day. So let's just play this forward a little bit. I can see that we got the higher low W formation in my area of interest. Now this would be considered a single session W formation because both of these points happened in the Asia session. So I'm going to let this one be and see if we can get another higher low or come back into this area of interest during another session. Yeah, cool. So I can see that we've come back into my area of interest and recovered the rest of this vector candle, and we have bullish candles out of that area of interest, and it happened in another session. So this is where I'd be open to opening a long position with the entry off the bullish engulfing, my stop loss below the first peak of the multi-session W. So now that I have my entry, I want to make sure that it meets my minimum risk to reward so that we don't screw up our calculations that we've inserted here. So far I cannot see any unrecovered vector candles during this move until this red one. So if I mark that out, this is going to be my target for my trade, and I'm going to see if that meets my minimum risk to reward of 3-to-1. And I can see it's a 3.26 to 1 trade, meaning whatever I risk on this trade being 1%, which is $100 of our $10,000 account, then with this trade being a 3.26 to 1 trade, I should make $326 if price is to hit my target. Great, so I let this one play out and our target has been hit, meaning we bank this 3-to-1 trade, we take home $326, and this gives us 1 out of the 50 trades that we would have taken that gave us this calculation. Essentially, when you find W formations, it's a sign of an early change in trend, and this is where aggressive traders would take an entry. However, if you missed that move, if price is to continue to the upside, I want to try take advantage of the next move. So I'm going to draw what we call a Fibonacci retracement from the peak formation low to this current high, and then I would be looking for price to come back to either the 50 fib level or this golden pocket area, which is the 61 or 65%. What I could do is set up a limit order on the golden pocket area with a stop loss below previous market structure, with the target being the next unrecovered vector. So let's just go back in price. I have this one, but I want to find one. Yeah, see this one here. This looks better. And this is going to become my target. Next, I want to make sure that this meets my minimum risk to reward. So if I bring my take profit up, I can see that is a 5-to-1 risk to reward. If price is to come back, pick up my limit order and then head in the right direction. Remembering within this 1 unit of risk, it is whatever your trade plan allows you to risk, whether that be 1%, 2%, or a fixed dollar amount. For us, it remains $100. $100 risk to potentially make $500. I highly recommend, especially if you are still in this part of the trader's journey, that you stick to 1 to 2% until you can get that win rate up. So now we would enter these details into our profit and loss calculators, or if you're a member of TTC, then you would use the trade journal. So let me just grab these numbers by double clicking on our risk to reward tool. Grab my entry price, copy that, come along to the trading journal where it says entry price. I would paste that number in here. Stop level. Now you can type all of these numbers in manually, and my profit price, copy and paste that in here as well. If you are using any leverage, insert that here. The risk amount, we are risking 1%. And then any other details you want to enter, you can do that as well. Then you would enter these numbers into the exchange. So now that we've entered our trade details, our entry, our stop loss, and our take profit into the exchange in our trade journal, we want to see whether our trade gets picked up or not. So let's play this out. Great, our trade has been picked up straight off the golden pocket 61.8 area, and now price has moved in our favored direction, hitting our take profit, whilst at the same time containing our risk of $100 or 1%. The reason we want to keep our risk amount the same, whether it be 1%, 2%, or a fixed dollar amount, is because let's say you wanted to enter a trade here. You go and risk a random amount on it where, for example, instead of risking 1%, you now risk 3% to make up for those losing trades. This means if this trade is to go against you, you are now losing 3 times more the amount you wanted to risk. Now in this trade return calculator, the risk has completely changed, and that's going to shift the entire projected outcome of our strategy. If you're trading like this, where the amount you risk or the approach is constantly changing, it becomes nearly impossible to build consistency or track your progress over time. Now, before you start trading on an exchange, you can use the replay tool, so you can go back in time and test your strategy over, say, 40 to 50 trades to see how much money you would end up making from following your trade plan and strategy, and to see your win rate over time. So to use this replay tool, you would simply come up to replay in TradingView, select it, and then scroll back to a random point on the chart. If you see a setup, you can add your risk to reward tool, jot down your analysis using the text box, then hit play down the bottom here to see whether your trade would have played out or not, and whether it ends in a win or a loss. Another powerful way to build your trading skills without risking any real money is through paper trading. Or if your exchange offers demo trading, that is another way too. How it works is simple. Platforms like TradingView let you switch over to paper trading account where you can place simulated trades in real time or even go back and test past setups. You'll use the same tools, same chart, same market conditions, but without the emotional pressure of real money on the line. To do this, you simply head to the trading panel found at the bottom of TradingView, select paper trading and connect. You can then select trade and it will bring up this panel to the right here where you could enter your trade details just as if you were trading on a real exchange, placing market orders, limit orders, entry, take profit and stop loss. If you were going back and back testing using the replay tool, then just simply click that off and click X, come up to the bar replay tool, select the point on the chart where you want to go back to. And here, if you wanted to enter this trade for a short, you would simply click sell. That's going to enter you into this trade, and then you can drag your stop loss up to where your risk to reward tool is and drag your take profit down to your take profit area. Then you simply hit play and then see whether this trade plays out or not. And the same thing here, if I wanted to buy this trade because I see a W formation, simply hover over the blue line where your entry is, drag your stop loss down to where it is on your risk to reward tool and your take profit to your take profit area, hit play, and then we can see if this trade plays out or not. We already know it does because I did it in a previous example. Anyway, our take profit has been hit. Why you'd use it is to build confidence, sharpen your edge, and test your strategy without the fear of losing capital. It helps you build discipline, spot common mistakes in your process, test different strategies to find what best suits your trading style, and gain real practice before going live. So paper trading is like flight simulation for pilots. You want to crash in the sim, not in real life. Now, once you've taken 40 to 50 of these paper trades, the next step is to measure your progress. This is where your trade journal becomes essential. By logging each trade along with a screenshot, which you can do by coming to the top right hand corner of TradingView where there is a camera, grabbing a copy of the image or copying the link and posting that into your trade journal. By doing this, you can start to track things like your win rate and overall profit or loss during that period. Let me show you how that looks in the journal. Once you've entered all of the details of your trades here, you can come down into trade summary in the trade journal. So here I can see the number of trades I have taken, which is 4, the number of winning trades 2, the number of break even trades 1, and the number of losing trades. On the TTC trade journal, we can also see what pairs we are most profitable trading. So every time you take one of these simulated trades, just log it using the same percentage risk you plan to use on your real account, whether that's 1%, 2%, or something else. The TTC Trade Journal will automatically calculate your risk multiples based on your entry, stop loss, and exit. This way, you're still able to track your edge in a structured, realistic way, just like you would with real trades. Before we continue, I've got something exciting to share. We've just launched our brand new Trade Travel Chill membership to make learning the system even more accessible. Business class is for self-paced learners. It gives you full access to all of our courses, custom indicators, written updates, and past live sessions for under $100. And for those who want more hands-on support, first class includes everything in business class, plus access to live sessions, team support, and our full trading community. You can even pay with crypto, and yes, there's a 48-hour money-back guarantee. Now, you might be somewhere in the middle of this chart right now, caught in the rabbit hole of learning and improvement, and it's messy, it's frustrating, and it's exactly where 90% of traders give up. But if that's you, I want you to know something. You're not broken, you're not behind, you're just building. Because the truth is, for every trader who's ever made it to the other side of the trader's journey by using better risk management, following a structured plan, and ultimately financial freedom, has stood right where you are now, wondering if it's even worth it. But it is. That messy part in the middle is where growth actually happens. And if you're watching this video, practicing bar replay, journaling your trades, and learning how to track your edge, you're already ahead of the curve. The tools I've shown you today aren't just tips. They're the very things that will carry you through this phase and into the next with clarity, structure, and confidence. So don't stop now. Keep showing up one trade at a time, because phase 5 and 6, they're not for the lucky, they're for the consistent. And I really hope this video helped you take one more step forward.